Hello, everyone. Wanted to discuss a position that we took earlier this evening. It is a long position taken after hours. To give you a little bit of background about the trade, we opened up um, Sunday at 6 p.m., sold off pretty heavily, formed a higher low right there. Buying support came in. We ended up pulling up to 98.50 in kind of in what we look for as the wave pattern. We added a contract at around 96. We sold off. We added a second contract on the signal right there at around 96 again. Average price now is 95. Stop loss is at 93.50. The details of this trade, the risk to reward parameters are currently $85 risk to $1,000 reward. Once we break above this 98.50 swing high, our stop will get guaranteed moved up above entry. If we pull up and then pull backs at a higher swing low, our stop it will be above this swing, which then our stop will be reduced to around $10 to $15. The risk will be reduced to $10 to $15. Currently, though, our risk to reward ratio is 11.76. So we have 11.76 times more reward than the risk that we're taking on. This is a position trade, so we are going to hold it a little bit longer until targets get filled. Worst case scenario, we are holding it into the open tomorrow. To give you an idea of what this looks like on the on our biggest picture time frame other than the daily chart, we use a 60-minute. We do have a potential risk for a sell-off in the market right here if we can't break this swing high. What we are anticipating is that we pulled back to 75.75, and that was a deeper pullback than what we've seen over the past few weeks or the past few days, last week, and going into the end of the previous week. So what we're anticipating is a continuation to the upside, getting this target filled first if we have lack of buying support come in and if sellers are able to resist this price right here. If everything happens how we're expecting, we should be able to break that swing high, get our first target filled, and then the following target. The reason they're separated like that is we have it at an even $1,000 for this position. And worst case scenario is the market sells off right now and we get stopped out for $85 loss. Now, what's going to happen if we get a sell-off below that level where we continue to the downside basically like this and we break this low? That's going to be our first signal for a bigger picture 1, 2, 3 reversal, where if fundamentals and technicals are on the same side in agreement, we have a longer term short bias currently because it's been switching between short and long fundamental biases during the day, but primarily bigger picture we've had a long technical bias for the past week. We're not going to be taking the short trade until we get confirmation and agreement from fundamentals and technicals. For right now, going off of our 5-minute chart, which is our primary trading chart usually, we ended up adding those contracts and we're expecting a breakout to the upside, and this is the swing that we're looking to break, which was basically the level that buyers were able to take price up to on Friday. So we're expecting a break above that, and then we'll see how that break occurs if it does go up to that level. If we fail to even break 98.50 and we sell off, then that's what our stop is for. And basically, one other thing I wanted to show you was our four range direction chart, which what we like to do is to be on the cross of the 4 range. So if we have a positive 4 range cross right here, it gives us a little bit more backing if we are trading in the slope of the 50 and 200 day on the 4 range. Whereas if you see right here, these uptrends on the 4 range are pull-ups on the 5 minute. So it would be, for example, this pull-up right here is depicts this uptrend on the 4 range. We usually assume these pull-ups and these pullbacks as flags, pennants, and wedges, and try to continue in the same direction as the overall market until that trade gets invalidated. Where, to give you an idea, we had this pull-up right here with the short signal right there. Trade was invalidated, and then we had a long bias the whole time, which we did trade off of this this signal. The trade is posted on the blog. But what I'm going to leave you guys with is make sure that where you place your stop, it's at a critical level that's going to invalidate that direction. So to give you an idea, what we have right here, normally the maximum stop that we take on for one contract for our initial entry is around 5 to 6 points maximum, so $120. If we get stopped out on the first contract right away at $120, we don't trade the rest of the day and we take it as more of an analysis day. What we like to do is, let's say if there is no reason to have it at 6 points, because our invalidation point, for example, would be this swing low. It's not that smart to just have it down at 89, for example, for no reason. If you are going to have a wider stop, you're better off placing it below the low of after hours at 90.25. So you want to manage your risk as intelligently as possible and eliminate it as soon as possible. So, for example, the idea right here, if you took a long position anywhere here, you would trail these swings. You would have your stop right below there, stop right below there, stop below there, stop below there. If you did not take profit in this area, then you would have been stopped out right there for at 375. But basically, what we try to do with the stop management is not allow this to happen, where we're in a long position and we just gave back all this profit that we just made up. So that's the reason it's there. If you guys have any questions, send me an email or post a comment on the blog. Thank you.